Hey traders, Raghee here, and in tonight's free video, I'm going to keep it short and sweet, but I think it's going to be pretty darn awesome, and that's a look at the Dow. I've been harping on the Dow, and there's a reason, because the cause for my interest in the Dow has to do with the risk environment. Every one of the current setups I've been watching has been about yen weakness, Australian dollar strength, Canadian dollar strength, New Zealand dollar strength, and that is classic risk appetite, risk on. And what I want to be aware of now is that as we're wandering into this layer of resistance up between this 17,550, 17,500, even 17,600, this area where the market has exhausted before, we talked about this just the other day, nudging the bears awake at 17,550, and here we are testing 17,400. But I don't think this means that we're seeing all the bearish momentum we could see. And how do I gauge that? And this is what I want you to watch. And this is the crux of the video here. I want you to look for what I call a wave reversal or a rollover trade. It's one thing to try to take advantage of an exhaustion level resistance in the context of an uptrend, but it's a very different thing to try to take advantage of a break of support. One is exhaustion, the other is momentum. You can take the exhaustion trade and then use the momentum trade as guidance. Or you could take the exhaustion level as kind of an alarm, a wake-up call, and then look for the rollover to actually trigger the entry. The rollover would occur on the 240-minute time frame. Here's how you set it up. You have the 34 EMA wave on your chart. You identify the bottom line of the wave, which for this contract, the YM, is right around the 17,350 area, so I want to be just below that. At 17,345. We've exhausted at 550. We're starting to roll over. This is still a market that could be an uptrend. That's really the most important thing about finding a rollover chart. It should be one that you would have been willing to buy or maybe did buy and then get stopped out. Intraday, preferably shorter term, would be better. I'd be a whole lot happier if this were a 60-minute, but the example for this seems to be best on the 240. So I look for the rollover, and let me just show you the 60 for comparison. You'll notice how it kind of chopped and then rolled over. So not as ideal as the rollover could be on the 240 if I really want to see risk come off the table, and then I'm going to get opportunistic. I'm going to look to reel in those risk on, risk appetite plays, maybe get aggressive and look for some near-term risk off, but more importantly, I want to wait at corrective levels for opportunities to re-enter the risk on trade. And that's going to be with a negative CCI on the indicator here and a break of the 17,345 level.